Look at the world right now. We're literally watching a trillion-dollar tech conflict unfold right before our eyes. And it's shaping the absolute future of global power, trade, and wealth. It's really a story of silicon, energy, and just pure innovation. So ask yourself this. What happens when the world's most valuable AI chip maker, a company holding a near monopoly, suddenly faces a fully autonomous competitor? And get this, they're running entirely on domestic hardware. Well, it's a high-stakes scenario that absolutely changes the global market overnight. And honestly, the race is tighter than anyone thought. A recent Stanford AI Index report just dropped a truly shocking statistic. The performance gap between top US and Chinese AI models, it has narrowed to almost zero. We're talking just 2.7%. The landscape is shifting dramatically right in front of us. To navigate this shift, you need the right intelligence. Know China to do better business. Save time and money with expert insights on China trade and investment. Welcome to Trade with China. Section 1. Two distinct AI ecosystems. Okay, to truly grasp the global AI race, we have to look way beyond the raw code. Right now, the United States leads the pack in foundational research and massive compute scale. In fact, they hold about 75% of global intelligent compute power. But China counters with unrivaled manufacturing density. They actually have over 5 million AI researchers, and they're focusing heavily on making these systems work in the real physical industrial world. Section 2, the inference compute breakthrough. You see, the actual battleground is moving rapidly. It's shifting from just training models to actually running them. Let's define this really clearly. Inference simply means applying a trained AI model to solve real-world problems instantly. Think of an autonomous drone seamlessly navigating a dense, modern city. Now, training an AI takes massive power, but inference, it takes much, much less. And because inference requires so much less raw power, China has made a massive autonomous leap. They're successfully bypassing international chip restrictions by focusing hard on domestic integration. We are literally talking about 60,000 domestic accelerator clusters here, and they have plans to deliver 500,000 homegrown chips by 2026. They're running top-tier models natively right on their own hardware. So, what does this all mean for global trade? Well, the impact is immediate. Because of this rapid domestic substitution, Nvidia's market share in China has already slipped below 60%. There's no doubt about it. The global hardware monopoly is fracturing, and it's completely changing the calculations for global investors. Section 3. Powering the hidden supply chain. Let's move from the digital realm back down to the physical world for a second. Software needs hardware, right? And hardware relies entirely on raw materials. This is staggering. When it comes to global rare earth refining, the absolute crucial materials needed for advanced chips, China controls a massive 91%. The rest of the world combined holds just 9%. So, the absolutely crucial takeaway here is this. The US holds the design for the chips today, but China controls the physical materials required for tomorrow. It's like a giant puzzle. This refining monopoly gives China a profound long-term strategic advantage over the entire global electronic supply chain. And then we hit the energy bottleneck. AI data centers just consume incredible amounts of power. If we look at power generation growth from 2010 to 2024, China grew its capacity by 34%, while the US grew by only 6%. This divergence in infrastructure is absolutely massive. This creates a really stark reality on the ground. Right now, 13 US states are already hitting their power limits, which is actually forcing pauses on new data center expansion. Meanwhile, China's grid is engineered with ample reserve capacity. They are maintaining massive energy reserves to actively support this ongoing AI boom. Section 4. Capital risks and realities. So how does the money actually flow in these two systems? Well, in the US, the business model relies heavily on closed-source software, high-price subscriptions, and private venture capital. In China, though, the strategy focuses on open-source ecosystems, rapid industrial application, and backing from state and industry capital. These are basically two entirely different playbooks for monetizing technology. Now, the US approach carries a very specific macroeconomic challenge, the bubble risk. Over $100 billion in private capital has just flooded the market. However, the data shows that 95% of enterprises report absolutely no substantive return on investment yet. If these massive capital injections don't translate to real-world productivity soon, the market could for sure face a severe valuation correction. Let's contrast this with China's deployment edge. They currently hold a 60% global share in open-source AI models, and get this, an astounding 87% market share in humanoid robots. They're actively integrating AI into massive automated ports and smart factories as we speak. Their absolute focus is on immediate, practical, industrial deployment. Section 5. Winning the AI trade. So how do we synthesize all of this information into something actionable? Well, winning the AI trade isn't simply about who writes the most advanced code in some isolated laboratory. It really comes down to this powerful thought. The winner isn't about raw tech, but who integrates AI into the economy. The ecosystem that effectively translates digital code into tangible economic efficiency, that will be the ultimate victor in this global race. This channel will bring you practical knowledge to navigate business, investment, culture, economic trends, and communication tips in trades with China. Your comments really encourage us to realize our explainer value and update more useful information. Please press like, subscribe now for actionable insights and win-win solutions, not to miss the possibility to understand and make money in trades with China. The tools for the future are being built right now, so the only question is, whose supply chain will you be relying on?